So welcome back to Financial Accounting, and the purpose of this last little mini lecture 5D, Chapter 5, Part D, is to review the practice exercise 6 in your text, and also to which has to do with adjusting entries and that we have to make for retailer, and exercise 7, which has to do with one of our financial ratios, which is the asset turnover ratio. So without further ado, for the wonders of technology, I'm going to transport you, hopefully smoothly, to your e-textbook. And there it is, voila. So let me get my head out of the way. There we go. So these are adjusting entries, and there are two adjusting entries that we mentioned, additional adjusting entries for retailers. One is assuming we use a perpetual inventory system. We still need to compare the inventory that we actually have to the inventory that we're supposed to have. And any difference between those gives rise to what we call an inventory shortage or inventory shrinkage. So what happened in the case here, the inventory account has a balance of $67,400. But when we actually count the inventory, it's only $663,800. So ask yourself, and don't jump ahead and go right away to the answer. Take a pause here and try to write down yourself on a blank piece of paper, what is the entry to record the inventory shortage and how is it calculated? So I'm looking for an entry here, I'm looking for a debit, and I'm looking for a credit to adjust the carrying value of the inventory down to what it really is when we count it. So take a few moments, hit pause, and then come on back, and then we'll go over the answer. Remember, the grapes must suffer on the vine to get good wine. So don't go ahead and try to do this yourself. And then only after doing that, hit pause and come back for the answer. So here's the answer. So what we do is the inventory had been on the books at $67,400. The actual inventory based on the physical count is $663,800. So the difference between those two would be the inventory shortage. So we would debit cost of goods sold and we would credit inventory. You want more details on that? There are more details available, but there's the basic entry. Right? Debit cost of goods sold, credit inventory. So any shortage, we basically reduce the inventory and we increase the additional cost of goods sold. And we said earlier, if this starts to become really large, which it unfortunately has been for a number of retailers, they may actually set up a separate account for inventory, shortages as a result of theft, or they may disclose it in footnotes. Either way, it's a concern. That shortage, that we're constantly having to reduce the inventory because of shrinkage. So there's your entry. Now let's take a look at B. So B, a little bit more complicated. Sales refunds and allowances of $40,000 and merchandise returns of $15,000 are estimated for the current year's sales. So we do an adjusting entry at the end of the period. We take a look at sales and we have to ask ourselves honestly, of the sales that we have, what, based on our experience, what percentage or how much of those sales are likely to be returned? So they've calculated the number for you. They said of the sales you've already recorded, 40,000 of those are likely to be returned. So I have to provide for that. I have to make an estimate of the amount of returns that I'm going to have. And then also that stuff that's going to be returned, it's going to come back into inventory. And I estimate the cost of that stuff is going to come back as 15,000. Now, again, these are estimates. So these estimates may or may not be accurate. So at a later point, we may have to adjust them based on more current information. But all they've asked us to do now is set up the allowance, assuming that we've got $40,000 worth of returns and that those returns cost us $15,000. So take a moment. I will give you a hint that this is going to involve two entries, but take a moment and try to come up with these two entries. Hit pause, write your answer, and then, and only then, come on back. See you shortly. Well, welcome back. So the two entries are as follows. You've got to reduce sales by 40,000. So you debit sales and you credit customer refunds payable. That's my estimate of the amount of sales that are going to come back. So I debit sales and I credit the payable. Then when sales actually come back, I'm going to write them off against the payable. So if we issue someone a cash refund of $5,000, we would debit cash refunds payable and credit cash. If we gave someone else a $3,000 adjustment to their account, we would debit customer refunds payable and credit accounts receivable. But for purposes of where we are here, they want us to record the allowance. It's $40,000, debit sales, credit customer refunds payable. And now we also have to provide for the amount of the cost of the inventory. So we assume that the got a nice hefty markup here. The stuff that's being returned to us is going to have $15,000 is going to come back to us. So we set up an account, estimated return inventory, which is a balance sheet or an asset account, and cost of goods sold is reduced for the amount that's going to come back to us. Want more detail for that? There's more detail available there. Okay. So you should be able now to, if I ask you to do those entries, to make the entry to adjust the inventory, and also make the adjusting entry for estimated sales returns and the estimated cost of goods sold inventory return as well. All right, now let's take a look at this last one. This last one is a financial analysis problem. So again, we use ratios to help make sense out of the financial statements. So we're going to be measuring what we call here the asset turnover. So this is the relationship between sales and average assets. So the way we would do this is we would take the sales for 2017, our 20Y7. That would be your numerator. Your denominator would be the average between 480 and 540. For year 6, it would be 1,645,000 divided by the average of these two. And you'll get a number, and that number will say that for every dollar of assets, I've got X dollars of sales. So compute the ratios for those 2 years. So you're going to get a separate ratio for year 7, and you're going to get a separate ratio for year 6. Do that, and then come on back. And to answer the first question, round to 1 decimal place, and then do B as well. Is the change that we see, is it favorable or unfavorable? Right? So hit pause, and then try A, try B, and then come on back for an explanation. So for year 7 rather, it's 3.4. How did I get that? That was the sales for year 7 divided by the average assets, which were 480 and 540. You can see that there. And for year 6, it was 1,645,000 minus the average of 460 and 470. So it comes out to 3.5 for year 6 and 3.4 for year 7. So ask yourself, which year are they doing a better job? Well, remember, this says for every dollar of assets in year 6, I generated $3.5 worth of sales. And in year 7, I generated 3.4. Looks to me like that is a negative trend. Okay, so this is an unfavorable trend. So you compare this year to last year, I actually less effective using my assets to generate sales. Okay. All right, so for those of you who missed class, again, on Thursday, you're now up to date, assuming you've listened to these videos carefully. And again, for future purposes, if and when I miss class, which is extremely rare, I don't remember the last time I actually missed it. I've been doing this a long time, but if I, for some reason, miss class, you'll get an email from me in advance. Otherwise, you can assume class is on. I do recognize that some of you had good reasons for not being there, which is why I'm spending my weekend recording these additional videos. I hope they were helpful to you. So that's the end of the Chapter 5 supplemental videos. And I look forward to seeing you all on Tuesday. Don't forget to do your homework for Chapter 5. Be well, everybody. Have a great weekend.